Canadian Natural Resources just delivered adjusted funds flow of $4.4 billion in a single quarter, and the TSX slid anyway. The day's headline blamed U.S. airstrikes on Iran, and Brent crude moved sharply higher in response, yet the index finished lower rather than following energy higher. That divergence is the actual story, because it means the market was not treating the oil spike as a uniform lifting force across Canadian equities. The transmission was selective. Canadian Natural Resources, with production averaging nearly 1,643,000 barrels of oil equivalent per day in Q1 2026, absorbed foreign institutional buying as crude surged. Price volume action shows net inflows into energy names, while broader TSX components face selling. The position pressure change that made that inflow rational was not the oil headline alone. It was the $1.5 billion in shareholder returns Canadian Natural had already executed in Q1, including $1.2 billion in dividends and $3 billion in buybacks, which compressed the risk premium income-oriented holders were being asked to accept. CNQ's 26 consecutive years of dividend growth at a 20%.
The dual mandate reclassification of CNQ raised an immediate allocation question for Canadian income investors. If the commodity-sensitive leg of the energy trade now carries geopolitical event risk, what is the hedge leg inside the same capital frame? Fortis sits at $77.99 with a 3.3% yield and a rate base expansion path from $42.4 billion in 2025 to $57.9 billion by 2030, funded by a $5.6 billion annual capital plan. That trajectory is not priced by commodity markets. It is priced by regulatory return approval cycles, which are indifferent to Brent. Emera delivered Q1 2026 adjusted EPS of $1.37, up 7% year-over-year, while deploying over $870 million of its $4 billion 2026 capital plan. Canadian Utilities posted Q1 adjusted earnings of $242 million, with 94% of its $353 million in quarterly CapEx directed to regulated assets. These numbers share one structural feature. They are insulated from the same commodity event that drove CNQ's entry signal. The capital flow into the utility group did not come from growth-oriented mandates rotating out. It came from crash watchlist alding, income accounts that had been holding utilities for their downside buffer, not their upside optionality. The position pressure shift is that Iran-related volatility raised the cost of being underweight regulated cash flow assets for balanced mandates. Retail flows interpreted from price action show the utility trio held or advanced on the TSX down day, which is the observable signal without confirmed net flow data. The complication is that a 4% to 6% dividend growth guidance from Fortis through 2030 is attractive, but that guidance is debt-funded infrastructure build-out, and Fortis uses leverage to finance rate-based growth. High oil prices that feed inflation could force the Bank of Canada to keep rates elevated longer, raising the borrowing cost against that $28.8 billion 5-year plan. The utility hedge is not rate neutral, which is what makes the framing incomplete as long as the oil shock's inflation path remains unresolved.
Enbridge just printed a new all-time high at $80 per share, up 26% over the past 12 months, and still carries a 4.8% yield. That combination, record price and near 5% income, is the positioning paradox that resolves the question the prior two chapters raised. The resolution comes from Enbridge's structural repositioning since 2024. The company spent US $14 billion acquiring 3 US natural gas utilities, making it the largest natural gas utility operator in North America. It also took a stake in the Woodfibre LNG export facility on British Columbia's coast, connecting Canadian production to Pacific demand. These moves shifted Enbridge's revenue mix away from crude pipeline volumes, which are sensitive to Brent and regulatory pipeline approvals, and toward contracted utility throughput and LNG export capacity, which are sensitive to long-term demand curves for natural gas. The demand signal is concrete. AI data center construction is driving electricity demand that gas-fired generation must partially supply, and Enbridge's transmission infrastructure sits between the supply source and that demand. Tourmaline Oil's Q1 2026 free cash flow came in 35% higher than the prior year period, despite weak Canadian natural gas prices, because Pacific propane exports and hedging offset the domestic price weakness. LNG Canada's ramp means 2026 natural gas price realizations for producers like Tourmaline are expected to rise more than 30%, and the throughput to deliver that volume runs on infrastructure Enbridge controls. Domestic institutional buying drove Enbridge to its all-time high, not foreign commodity flows. The position pressure change was the recognition that Enbridge's post-2024 asset mix had crossed a threshold, where its cash flow now resembles a diversified utility more than a pipeliner. The $40 billion capital program the company is executing should lift adjusted distributable cash flow by approximately 5% annually over the medium term, supporting further dividend increases. The monitoring variable from here is whether that inflation oil feedback loop, Brent staying elevated, BOC maintaining rates, borrowing costs squeezing Enbridge's development leverage, interrupts the distributable cash flow growth before the next dividend increase cycle. The all-time high holds as long as Enbridge's utility-weighted cash flow compound is not interrupted by rate pressure that 2024 to 2023 demonstrated can push the stock down more than 20%. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.